Good morning. We'd like to thank you for joining the Gabelli Funds live webcast series. Today, we're joined by the Gabelli Funds Healthcare research team and Howard Ward, Chief Investment Officer of Growth Equities. This morning's timely conversation will be centered around the COVID-19 virus and the global economic impacts. Our healthcare team includes Jing He, Sarah Voida, Jenny Tsai, and Jeff Jonas, and they'll begin the discussion around the recent developments surrounding the virus, and then the call will be turned over to Howard. Finally, we'll have a Q&A session for you to ask questions to our team. I'd like to now turn the call over to Jing.
Hi, my name is Jing He, and I'm a biotech analyst. First, I'll give you an overview of the disease. There have been over 94,000 people diagnosed since the outbreak in China in December 2019, with over 3,200 cases of deaths or 3% death rate. Recently, the virus has spread across continents, raising concerns for pandemic. While the number of cases has been stabilizing in China, Singapore, and Thailand, multiple outbreaks occurred in other countries, including South Korea, Iran, and Italy. Thousands were diagnosed in each of these countries. In the US, there were 162 cases and 11 deaths. We've seen community spread in the states such as Washington, California, and New York. There is no treatment approved for COVID-19. Severe patients usually receive supportive care such as supplemental oxygen and ventilation. In terms of potential treatment, Gilead's remdesivir is the most advanced in development. The company has initiated a phase 3 trial in China in February and is now expanding the trial to other countries. The drug was initially developed to treat Ebola and now showed promises in a few COVID-19 patients for compassionate use. In terms of the market potential, we may use Tamiflu as an example. Stockpiling of Tamiflu led to an accumulative sales of 4 to 5 billion in 2 years during H1N1 outbreak in 2009. If COVID-19 lives with humans like H1N1, the cumulative sales could be 10 billion over 10 years. We expect to see initial results from this trial in a few weeks. Regeneron is developing an antibody drug. They have developed a potent Ebola drug, so we think their platform is solid. But it will take longer than Gilead, since they may start to test in humans in the summer. Vir Biotechnology is another company developing antibody drugs, but their platform has not yet been validated. On the vaccine side, Moderna plans to test their vaccine in phase 1 in late April. Moderna has not yet had any approved vaccines. Other companies, including Glaxo, Sanofi, and J&J, are also developing vaccines. Given the longer time of development for vaccines than drugs, we do not expect a vaccine to be widely used this year. In terms of drug supplies in the US, the FDA put together a list of 150 drugs that are at risk of shortage if outbreak in China worsens. We believe the risk of drug shortage is extremely low for most non-oral biologic drugs since they are made outside of China. This includes vaccines, biologic infusions, blood derivatives, cell and gene therapies. The risk could be slightly higher for generics or oral drugs since the majority of raw materials, as well as some active pharmaceutical ingredients or APIs, are manufactured in China. For the companies we spoke to, most of them have 6 to 24 months of safety stock and multiple suppliers for blockbuster drugs. From a revenue standpoint, I don't expect much pressure on sales across the industry. The most vulnerable category is antibiotics, as 90% of raw materials are sourced in China. In terms of exposure to China, among large pharma companies, AstraZeneca has 25% of its sales from China. Merck, Roche, and Sanofi each has 15%, and Novartis has 10%. Most biotech companies have very limited exposure in China. That's all for me.
Hi, I'm Sarah Voida, Diagnostics and Life Sciences Analyst. So in regards to testing for coronavirus, there are various companies ready with products to ship around the world. Most of the testing today is being done by public health labs. Compared to the SARS outbreak, which took around 6 months to establish a test, these companies have made substantial progress in developing tests over the past few weeks. Once developed, they try to get them validated for clinical use. Most of these tests are PCR-based, which stands for polymerase chain reaction. Researchers are also trying to develop antibody tests, which would show if someone has been exposed to the virus, how broadly the virus has spread, or if the milder cases were not detected. The BGI group in China is producing commercial tests and has opened a lab in Wuhan that can process 10,000 samples per day. China has enough materials, but there's a limited number of technicians who can run them, so workload on these operating labs are very high. The test is highly sensitive, so a false negative, which means the failure to detect the virus in an infected patient, can be a big problem with high volume setting under heavy pressure. The timing and the type of sample is also crucial, and collection via nose and throat swab is considered the most effective right now. Meridian Bioscience manufactures a PCR mix, which is being used by Chinese diagnostics companies and labs to develop quick molecular diagnostics for the coronavirus outbreak. The unique benefit of this assay is that it can be set up and freeze-dried, so it is highly stable, just requiring the patient sample to be added and the assay run. Each cycle takes a total of about 12 minutes. Thermo Fisher has also developed a real-time PCR kit. The company is also developing a faster multiplexing kit that expands lab capacity, which should also be available soon. QIAGEN has developed a respiratory panel that can detect 21 pathogens. Samples and reagents are delivered in cartridges and analyzed on their desktop within 1 hour. The prototype was shipped 2 weeks ago to assess performance in China and Europe. Overall, the US had a slower start to testing due to a faulty test kit and strict regulation. Now, the country says it plans radical expansion of the testing. It has over 75,000 diagnostic kits available, with more on the way. The issue before was only certain CDC-approved labs were capable of diagnosing the virus. The US government has since created a new recommendation that allows high-complexity testing labs to make and use their own tests. Since then, many more labs have applied for emergency test approval, submitted evidence that those tests work, and will be able to run tests immediately. And that's all for me.
I follow medical companies in orthopedics, general medical supplies, and dental, such as Stryker, Zimmer Biomet, ICU Medical, Align Technologies, Cooper Companies, and many more. These medical device and products are used in elective procedures such as knee and hip replacement surgeries, dental procedures, and supplies used in the hospital settings during procedures. Some medical companies have exposure to the Chinese market, typically 8% of net revenues or less. This includes Medtronic, Becton Dickinson, and Smith & Nephew at 7%, Align Technologies and Vista Corporation at 8%, Zimmer Biomet less than 5%, and Dentsply Sirona has a 10% exposure to the East Asian region. Zimmer Biomet commented this week that it's experienced an 85 to 90% reduction in procedures through February, and this will continue through March at a minimum. They have 3 of their 30-plus plants in China, although they're operating at 90% production or better. And they're seeing some headwinds in Korea and will be monitoring trends in other countries. Stryker has said that all elective procedures have stopped in China. In summary, many elective procedures are being postponed in China as the healthcare resources are being used to treat coronavirus patients. Most medical companies do have exposure to certain geographies, such as Japan, which is the second largest medical device market after the US. Any slowdown there due to the coronavirus will impact revenues. With respect to the supply chain, some medical companies have manufacturing facilities in China, and many companies also source components from China with some safety stock on hand and will be securing components elsewhere as needed. Many of these companies are making contingency plans to make sure there is sufficient supply to meet demand, especially when it comes back.
Well, thanks. This is Jeff Jonas, portfolio manager on the healthcare team. I guess I'd say one of the consistent themes about this coronavirus outbreak is that it's been underestimated, both its spread and its economic impact. Clearly, that was the case in the stock market, which through the third week of February thought this would be contained to China or manageable beyond China. Governments around the world have also been slow to react. China was as much as 2 months late in acknowledging the virus and responding. We do believe they're still underreporting the total number of cases, but believe that directionally the new infections have leveled off thanks to their extraordinary efforts. I'm not sure any other country in the world has been particularly well prepared for the spread that they've seen since either. More importantly for us, companies have been slow to respond and include it in their guidance. You just heard about Zimmer and Stryker warning of the crowding out of a lot of procedures in the first quarter. And I think it's been far greater than expected and far greater than most companies put in guidance in January and February. So I think a lot of numbers are going to be coming down for both earnings and revenue, not just for the first quarter, but clearly continuing into the second quarter. And that's going to impact a lot of the global healthcare companies, especially across medical devices, life sciences, and pharmaceuticals. Hopefully, though, this is already priced in given the declines that we've seen in the market over the last 2 weeks. Overall, though, it's our belief that Bernie Sanders and the election have been the bigger impact on healthcare stocks and probably an underappreciated factor in the broader market's decline. Last summer, we saw healthcare stocks suffer greatly when Elizabeth Warren and Bernie Sanders had momentum with their Medicare for All plans. That faded in the fourth quarter, especially after Elizabeth Warren laid out how draconian and unrealistic the taxes would be to pay for it. But then in January, Bernie Sanders rose again in the polls, somehow getting a free pass on how to pay for it, and the stock suffered again. We've been surprised at the turnaround over Super Tuesday and how quickly the Democrats have rallied behind Joe Biden and the rally that we saw yesterday. But if Medicare for All is truly off the table, then I think the political risk through November will be much less than in past elections. And I guess the bigger factor is that all these things have been combining to increase the volatility in the market. The coronavirus, the falling earning estimates, the falling stock market, rising recession fears, and the potential for a far-left candidate for president. Super Tuesday clearly put a dent on the far-left candidate for president, and hopefully we priced in lower sales and earnings estimates. But for a more complete view of our macroeconomic thinking, I'd like to turn it over to the head of our growth investments, Howard Ward.
I want to start by simply giving you an update on where the markets stand today relative to recent history. Some of you really might be interested to know that the Dow, which was around 26,400 a few minutes ago, is actually 1% lower than it was at its high in January of 2018, 25 months ago. For the S&P, it was around 3057 this morning, the last I looked, still 6% above its high of January 26, 2018, 25 months ago. At one point last week, during the bottom of the sell-off, the S&P was lower than its January 26, 2018 high. So obviously the coronavirus is dominating talk about the economy and the markets. This is somewhat of a black swan event in that it's a very low probability of happening, but it's capable of widespread destruction. It's clearly now a headwind to global economic growth. I've been listening to a lot of infectious disease experts, and everything that I hear and read tells me that we are in the early innings of this process here in the United States of working our way through this. You know, the first or second inning is probably not a bad guess. So investors are now resetting their expectations for both GDP growth and earnings. We don't know whether earnings are going to be $175 on the S&P this year, which was the consensus going into the year, or whether they will be 170, 165, 160. There's just tremendous uncertainty. And it's very hard to value stocks when you have so much uncertainty regarding the earnings outlook. Some of you are looking at the February economic data and it looks pretty good. But as you know, that's really pre-coronavirus for most of the world. The data will weaken from here. GDP growth in the first half of the year could be zero. Recession talk is going to surface in greater frequency. I think it's early to be forecasting a recession. I don't think you can rule it out. We could be in a recession right now, and we would not know that until this summer. The economic weakness is both supply and demand driven. As you know, supply chains have been disrupted, especially for businesses that rely on China for sourcing products and raw materials. Business travel, as well as consumer travel, is being curtailed, if not outright canceled. Events are being canceled. We were going to have a symposium on ESG investing early next month. That's been canceled or postponed, I should say. We have a large client event scheduled for May. We will have to consider what to do with that. No decision has been made at this time. You're seeing schools closed overseas, Italy being the prime example. You're seeing sporadic here and there, some school closings here in the US, and I think that's going to spread. I heard a story this morning from someone who works at AllianceBernstein to the effect that should anyone in their building contract the disease, or the virus, I should say, they will probably close the entire building. So while we don't know exactly where earnings are going to rest at the end of the year, the $175 estimates on the S&P going into the year called for a 6% gain, and about half of that was coming from share buybacks. I think it's probably not an awful guess to look for flat profits this year, which would be about $165. Admittedly, that's more of a guesstimate than an estimate at this point, given the uncertainty. But what's very important here is the direction of the earnings estimate revisions, and there's no question the direction of those revisions is down. So we have a situation now where both earnings and multiples are in play, and that creates heightened market volatility. I really do believe that long-term investors, people who are truly committed to the long term, are probably best served by sitting tight and doing nothing. I know that's what I'm doing with my own portfolio, for whatever that's worth. The risk of getting whipsawed in a market this volatile is just too great. And if you feel you must panic, I would panic a little, not a lot. I think a series of small moves will present a better outcome than one big move. We are having a major healthcare crisis. As I mentioned, early innings. The economic activity is going to take a hit regardless of what the Fed does. The Fed argues that cutting rates now will make for a stronger rebound when the virus passes. Okay, fair enough. That may be the case, but the immediate impact on behavior is essentially hard to measure. These events are going to get canceled. The travel is going to be canceled. People are going to be sitting in their homes or in their offices. They're not going to be going out as much, and that's regardless of what the Fed does. Having said that, the market, after the Fed did their emergency cut of 50 basis points, the market's already pricing in 2 to 3 more cuts in the next couple of months. Last week did a lot of technical damage to the market. It blew through the 90, 150, and 270-day moving average in 3 consecutive sessions, taking the S&P back to its price in January of 2018, as I said initially. To recover from a market with this level of damage typically takes time, probably months as opposed to weeks or days. And a sustainable recovery requires clarity. We don't have that. When you play with the numbers, if you put a 17 multiple on earnings of $165, that would equate to 2,800 on the S&P, which would have been down 10% from last night's close. So I would advise patience. It's been my experience in my 42 years on Wall Street that rushing back into stocks on bounces after this kind of a move is often a mistake. It's one thing if you have a flash crash, a fat finger flash crash type of thing, which is not really connected to economic fundamentals. Yes, the stocks can quickly rebound. But when there's a fundamental change in global growth of unknown duration and magnitude, I don't think I would be too hasty putting cash to work in stocks here. There are going to be up days. We saw a nice up day yesterday, but there will also be down days. And if earnings growth turns negative for this year, there will undoubtedly be new lows. Stocks were fully priced after the longest economic and bull market expansion in history. After all, we hit a new high just 2 weeks ago, and the stock market cap as a percentage of GDP was at an all-time high. All-time high. PEs were about 20 times current year earnings, highest since the dot-com bubble. So we were overdue for a correction. The market had gone straight up since October 2 weeks after the Fed began building up their balance sheet again with the latest iteration of quantitative easing, even though they don't call it that. And during that rally that commenced in early October and ended a week ago, the Fed increased the size of their balance sheet by about $400 billion. That's a lot of liquidity. So the question we face now is, do we stop at a market correction, or do we have a full-blown bear market down around 20%? The bond market certainly seems worried. Bond yields are at record lows. Bond yields were at record lows before the Fed did anything. Credit spreads are widening. They're not widening to such an extent now that's truly alarming, but they are widening, and we'll have to watch that carefully. Watching the price of oil fall. We're down around $50 on Brent, $50 a barrel on Brent. Should that continue to fall, you have to think the bond market's going to be very worried about a lot of the high yield debt that's in the energy patch. The PMIs, which we look at, they are hooking lower. The JP Morgan Global Manufacturing PMI, which had just gotten back over 50, hooked down to around 47.1 for last month. I would expect the PMIs to continue to decline. If you go back for a quick PMI review, we had seen a little bit of a rebound from the mid 40s to back over 50 on a number of these manufacturing indices. There was hope that we were breaking out to the upside. Now we're definitely rolling over. This is similar to what happened in 2007-8, where the PMIs were below 50. They rallied for several months, got back above 50, and then they collapsed into the mid 30s. So this bears watching. When PMIs are below 50, and when I'm talking about the manufacturing PMI particularly, if it's below 50 and earnings are falling, not rising, you should expect multiples to decline. This is the period in the market which represents the greatest risk to stocks, and we could have a very short but painful correction. I don't want to sound too bearish because, you know, recession or not, when the smoke clears, this economy should improve quickly, especially with all of the renewed monetary stimulus globally, not just domestically. There is real market risk, but I think it's of the short-term variety, you know, several months here until we get some clarity on the outlook. The economy was pretty strong in February. It was in good shape. And I think we can avoid a recession, but we will no doubt have days when the downside volatility is going to make your stomach turn. I'm going to stop there and turn it over for Q&A.
As we wait for questions to come in, we have a few that were submitted prior to today's call. This first one is for Jane, comes from Charles in New York. What would a profit model look like for a vaccine maker? My understanding is that Chinese manufacturers are producing and distributing equivalents to branded drugs for distribution without waiting for proof of efficacy against the coronavirus. What are the chances of any of the branded patent holders receiving compensation for that production?
Okay, thank you for the question. So I'll break it into a couple parts. First, what drugs have been used in China? As of now, as I said, there's no approved drug. So most of these drugs are generics. I wanted to highlight AbbVie's Cletra. That seems to be the one that is a little bit more effective than, let's say, a Tamiflu for this disease. But in the meantime, this is generic already. I think AbbVie is still making it. If anyone is making Gilead's drug, which is the innovative drug, at this point, I don't see any widely used in the country now. Let's say in the case they can make it, and if there's a widely used, let's use Tamiflu as an example. Back in 2009, Canada forced the drug companies, which was Roche and Gilead, to give away the manufacturing so they can do it themselves. In this case, I think Roche and Gilead probably get 10% as licensing fee or even lower. And then this followed by some Asian countries back in 2009 as well. I think in this case, at least for this year, it will be pretty much emergency use. So you would expect similar forced license like this. But the stockpiling of Tamiflu, the 4 to 5 billion of sales I talked about in my remark, it's pretty much stockpiling in developed countries in the next few years. So that would be a good starting point if you think about the numbers. And the last part of the question is the vaccine market. So for vaccines, the flu vaccine we have here, I think over 10 years, the sales, accumulative sales is probably 20 to 30 billion. So that's a good starting point to think about. And if you think about other vaccines, pneumonia, the peak sales will probably be like 4 to 5 billion per year. So again, we won't be able to see a vaccine in a year-ish. So I think it's a bit too early to talk about whether we'll have a vaccine, whether we'll need a vaccine just for 1 year, or this disease will stay with us multiple years. That is hard to say.
Great, thank you, Jing. This next question is for Howard. Comes from Frank in Ohio. He says, Howard, on your last webcast, you spoke about the impact that a rise in unemployment could have on the market. How do you see the virus affecting employment moving forward, and have you started to see anything in recent numbers signaling a change?
Yes, Frank, you're right. We'd like to look at those employment numbers, the weekly jobless claims, as well as the monthly additions to the payrolls. And we really like to look at the weekly jobless claims, 4-week moving average for immediate indications for what's happening. And that number has been incredibly strong, stronger than I would have expected in recent months. With one thing that I have to say, because it was sort of lost in all the noise that comes out with these announcements. Not so much for the weekly, but for the monthly payrolls, which have also been generally stronger than expected earlier in the, from last year, which was the government does they're constantly revising these numbers once, twice, 3 times, and once a year they go back and they do a reset for the previous year. And when they did this last month, it was for covering 2018. And I believe it was 2018. And anyway, in that revision, the economy lost 500,000 jobs. So in addition to the monthly revisions, you get an annual one that is very backward looking. And so we now know that the baseline was 500,000 jobs lower than we thought it was. But there has not been any material uptick in the weekly unemployment claims yet. However, given what we're expecting out of the virus, I do think that's going to be happening in the months ahead.
Great, thank you, Howard. We have a question here from Mike. In terms of the best estimates, when do you think a vaccine will be created? And secondly, how quickly do you think it could be distributed? Do you anticipate it this year or next year?
Thank you for the question. So I think we'll answer part of the question. We won't be able to see a vaccine in a year, even though some company has already started planning to start to test in April. I think if everyone will to get this vaccine, then we'll definitely have a supply issue down the road. At this point, it's really unclear how fast we can manufacture these vaccines, given the disruption. We can't really estimate that in the US at this point. I think the more promising thing is on the drug side. So Gilead has started testing their drugs. The animal studies show some promises. We've seen some compassionate use for the patients in US, Italy, also France. I think at this point, that's our best bet. And then we'll probably have some data in the next few weeks, probably April, we'll get some data from Gilead. And then on the FDA side, I think the meeting that Trump had with the pharmaceutical companies are very positive. I think the FDA will sure fast track its drug if this works. The first couple of patients will get the drug will probably be people being hospitalized or being severe or moderate. I think they will get the drug first, and then we'll move on to the milder ones. But the drug will be much easier to make. This is a small molecule. The only challenge will be this is an infusion for 5 to 10 days. So we'll have to manage the logistics, but making the drug is still easier than vaccines. And in the meantime, Gilead, I've been talking to the company in the past few weeks. They've started making this drug since February when they saw the outbreak in China. So at least that's some positive execution on Gilead's side. The other drug, I have a lot of hope in Regeneron's drug, but again, that is harder to make. The trial takes longer, and we'll probably see some result end of this year.
Great. A question here from YouTube. What can policymakers do to prop the market? Can strong fiscal or monetary actions be enough?
So it's all a question of timing. On the monetary policy side, again, there's really nothing that's going to change the behavior of consumers or businesses to any real degree. until the smoke starts to clear. But once the smoke starts to clear, you might get an extra spring back from the extra monetary liquidity. On the fiscal side, I think the best thing you can do from a government standpoint is make sure that all of the medical costs associated with this virus is covered for people who don't have insurance, for people who lose their jobs as a result of the virus, perhaps extend the unemployment benefits of some sort so that people have sufficient funds to continue their normal daily lives to the extent possible. I don't think that other fiscal policy measures are terribly effective, either because it would take so long for them to be implemented, or because, again, they wouldn't have any real impact on behavior. I think the best thing is to make sure you can firm up the finances of people that are directly affected by this.
Great. Thank you. We'd like to thank Howard as well as the healthcare team for joining us today. And we'd like to thank all of you for joining as well. If you have any questions or would like a replay of today's presentation, you can contact your investment representative, or you can call 1-800-422-2274. Thank you, and have a great rest of your day. Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.